There's an institution in this country that prints your money, sets your interest rates, decides whether you can afford a house, and answers to almost nobody. You don't elect anyone who runs it. You can't vote it out. And every single thing about how it works has been carefully designed to keep you from understanding what it actually does. Today, the Federal Reserve is on trial. We're going to examine 7 specific lies this institution tells the American public about how money works. By the end of this video, you're going to understand more about the Federal Reserve than 95% of the people in your office. Sit down. Court is in session. Welcome to Capital Court. I'm not a financial advisor. I'm not on television. I don't work for a bank. What I am is somebody who got tired of being lied to about how the economy actually works. So I started looking, and what I found is uglier than I expected. If you want to understand the system that runs your financial life, really understand it, not the version your high school econ teacher gave you, hit subscribe. New case every single day. Now, the defendant, the Federal Reserve. 7 lies. Let's begin. Exhibit A, lie number 1. The Federal Reserve is independent. This is the first thing they teach you. The Fed isn't political. The Fed isn't a government agency. It's independent. That word does a lot of work and most of it is wrong. Here's what independent actually means. The Federal Reserve System has 12 regional reserve banks. Each one is owned, literally owned, by the private banks in its district. Bank of America, JP Morgan Chase, Wells Fargo, Citigroup. They are the shareholders. They appoint 2/3 of the board of each regional bank. They receive a fixed dividend on their stock every year, written into the original Federal Reserve Act of 1913. The institution that decides how much your mortgage costs is owned, in significant part, by the institutions that issue your mortgage. That isn't independent. That's something else. It has a different name in any other context. It's called a conflict of interest. The verdict on Exhibit A, guilty. Exhibit B, lie number 2. The Federal Reserve fights inflation to protect you. The way they tell it, when prices go up, the Fed raises interest rates. Demand cools off, inflation comes back down. Everybody wins. You especially. Here's what actually happens. When the Fed raises rates, the first people who feel it are the people who borrow money to live their lives. People with variable rate credit cards, people shopping for a mortgage, people with student loans on income-driven plans, small business owners with lines of credit, renters whose landlords have floating rate financing on the building they live in. You feel it first. The people who don't feel it are the ones who already own the assets. They bought houses when rates were 3%. They locked in cheap business debt years ago. They have cash earning higher yields now. For them, inflation fighting is a free upgrade. For you, it's a tax. The Fed didn't fight inflation in 2022. It transferred wealth. The verdict on Exhibit B, guilty. Exhibit C, lie number 3. The Federal Reserve has a dual mandate to serve the public. Full employment and stable prices. 2 goals. Sounds balanced, sounds democratic. Look closer. In practice, the Fed has spent the last 40 years treating inflation as the emergency and unemployment as the lever it pulls to fight it. When unemployment falls below a certain threshold, the Fed gets nervous. They worry workers might have too much bargaining power. They worry wages might rise faster than corporate profits. So they raise rates. They cool the economy. They make sure unemployment stays high enough that you can't comfortably ask your boss for a raise. The dual mandate, in practice, is a single mandate. Keep capital safe. Workers are the variable. The verdict on Exhibit C, guilty. Exhibit D, lie number 4. The Federal Reserve controls inflation through interest rates. Watch the news any given week. Inflation report comes out. Headlines say the Fed will or won't raise rates in response. Everyone treats this like the Fed is steering the inflation ship. Here's the problem. Interest rates don't actually fight most of the things that cause inflation. They don't lower oil prices. They don't fix supply chains. They don't bring chip factories back online after a pandemic. They don't shrink corporate margins on groceries. The only thing interest rates reliably do is destroy demand. They make it more expensive to borrow, so fewer people borrow, so fewer purchases happen, so prices stabilize because nobody can afford to buy anything anyway. That's not inflation fighting. That's induced economic damage. And the people who eat that damage are not the people whose decisions cause the inflation in the first place. The verdict on Exhibit D guilty. Exhibit E. Lie number 5. This one is different. This is a lie people tell about the Fed, not a lie the Fed tells. It still belongs on this list because the Fed lets it stand. The lie. The Fed prints money out of thin air. You hear this everywhere. Stimulus came. Money got printed. Currency got debased. Inflation followed. Clean story. Mostly wrong. Here's what actually happened in 2020 and 2021. The Treasury issued bonds. The Federal Reserve bought a large share of those bonds, not directly, but in the secondary market through what are called primary dealers. In exchange, the Fed credited the dealers' reserve accounts. Those reserves are not money in your pocket. They are sitting on the balance sheets of the banks the Fed bought from. The inflation that followed wasn't because the Fed printed anything you could touch. It was because Congress sent actual dollars directly to households and businesses through fiscal programs. At the same time, supply chains were broken. That's a fiscal story, not a Fed story. Most of the Fed's so-called money printing never left the banking system. But the Fed lets this lie sit because it is a convenient distraction from the things it actually does. The verdict on Exhibit E, guilty of neglect. Exhibit F, lie number 6. The Federal Reserve is run by elected officials accountable to Congress. The Board of Governors has 7 seats. They are nominated by the President and confirmed by the Senate. Sounds democratic. Sounds normal. Hold on. The Federal Open Market Committee, the body that actually sets interest rates, has 12 voting members. 7 from the board, 5 from the regional reserve banks. Those 5 are not appointed by anyone elected. They are selected by the private banks that own the regional reserve banks, with rubber stamp approval from the board in Washington. So at every rate-setting meeting, 5 out of 12 votes belong to people who were chosen, ultimately, by the banking industry. 42% of the most important votes in American monetary policy are cast by people no voter has ever heard of and no voter can remove. The verdict on Exhibit F guilty, Exhibit G, lie number 7. The Federal Reserve is accountable to Congress. Technically true. The Fed chair testifies twice a year. Congress sets the Fed's mandate. Congress could, in principle, audit the Fed. In practice, Congress has been waving the Fed past meaningful oversight for 100 years. The detailed audit of the Fed's emergency lending facilities during the 2008 financial crisis didn't happen until 2011, and only because one senator forced it through an amendment to Dodd-Frank. What it revealed was that the Fed had extended over $16 trillion in emergency loans to financial institutions, including foreign banks, while ordinary Americans were losing their homes. That number, $16 trillion, was larger than the entire United States economy that year. Congress is not accountable to the Fed. The Fed is not accountable to Congress. They have an arrangement, and you are not part of it. The verdict on Exhibit G, guilty. So what does all of this mean? The Fed isn't independent. The Fed doesn't fight inflation in any way that helps you. The Fed has a single mandate disguised as a dual mandate. The Fed's main tool doesn't address most causes of inflation. The Fed's so-called money printing mostly stays in the banking system. Most of the Fed's leadership is unaccountable to voters, and Congress isn't really supervising any of this. Here is the part most people miss. This isn't an accident. This isn't a flaw in the system. This is the system working exactly as designed. The Federal Reserve was created in 1913 by a group of bankers and senators who met in secret on Jekyll Island, off the coast of Georgia, in November of 1910. Senator Nelson Aldrich, Paul Warburg from Kuhn, Loeb and Company, Frank Vanderlip from National City Bank, Henry Davison from J.P. Morgan, Benjamin Strong, who would later become the first president of the New York Fed. They drafted what became the Federal Reserve Act. They wanted an institution that could backstop the banking system in a crisis. They wanted to smooth out the credit cycle. They wanted to keep regulatory authority insulated from the kind of populist politics that had broken up monopolies a decade earlier. They got everything they wanted. The architecture you're looking at is the architecture they designed. You weren't supposed to understand it. That was the design. The verdict of this court. The Federal Reserve is functioning. It is doing exactly what it was built to do. The problem isn't that the system is broken. The problem is that the system was never built for you. Now you know. That's the first step. If this changed something for you, hit subscribe. New case every day. Tomorrow we put your grocery bill on trial and we name the specific mechanisms that made everything you buy more expensive, even when the inflation rate finally came down. While the Fed plays its games, here's one thing you can do today. In the description below, you'll find a high-yield savings account that pays more than the bank you almost certainly have your money in right now. Affiliate link. Use it if you want to support the channel. Court is adjourned. See you tomorrow.